So I think we have some people online that are just entering the meeting. I'd like to welcome everyone who's here this evening for tonight's Law and Business seminar on 5 years of crowdsourced funding in Australia, taking stock literally. My name is Jennifer Hill and I'm the Bob Baxter AO Professor of Corporate and Commercial Law at Monash Law School and the Director of CLARS, or the Centre for Commercial Law and Regulatory Studies. Before we get underway, I'd like to acknowledge the traditional custodians of the land on which we are today, the Wadawurrung peoples of the Kulin Nation, and I do pay my respects to elders past, present and emerging, and also to any First Nations people who are online or joining us this evening. So the title of tonight's seminar really says it all. It is now 5 years since equity crowdsourced funding hit Australia. And the goal of tonight's seminar is to reflect on its trajectory during that period. And of course, there have been a lot of other shifts in the corporate governance landscape during that 5-year period, most notably, I think, the rise of ESG. So the first of our speakers tonight, and we're very grateful to have experts in the field. Our first speaker is Professor Andrew Schwartz from University of Colorado. Andrew is a leading international scholar in the field of crowdsourced funding, and he's the author of a new book on the subject, Investment Crowdfunding, which is forthcoming from Oxford University Press. Is it out yet, Andrew, or still forthcoming? The wheels move slowly over in England. Before becoming an academic, Andrew clerked for 2 US federal court judges, and he worked at the legendary New York firm of Wachtell, Lipton, Rosen and Katz. And Andrew has in recent times been spending quite a bit of time as a Fulbright scholar in New Zealand. We're also very fortunate to have with us as commentators Kelly Morton and Matt Vitale. And let me tell you about Kelly first. Kelly is the Chief Legal Officer and Director of Birchal, which is Australia's leading equity crowdfunding platform. She was a partner of an Australian law firm, and then she founded her own business and worked as a lawyer in New York, London and Australia, where she was assisting in startups and large corporations with M&A, private equity deals, etc. Kelly says that she's passionate about Aussies bringing their ideas to life and demystifying, modernising and simplifying capital raising in both companies and investors. And Kelly, we need you in universities in Australia because we'd love to demystify, modernise and simplify everything in Australian universities. Matt Vitale is also here with us. Matt and Kelly are going to speak together. Matt is the co-founder and managing director of Birchal, and he's an experienced financial services lawyer and entrepreneur who has worked in private practice at top law firm and founded several successful businesses. And he's an expert in the regulation of financial services and crowdfunding. And we actually have a course in that running this week, financial services, with Justice Ashley Black teaching it. But unfortunately, he wasn't able to be with us tonight. Matt's a regular media commentator and he contributes to scholarly journals and industry consultations. So we're excited to hear from you guys about what you think is happening with equity crowdfunding generally as a financial tool, and particularly in what you think's been happening in Australia over the last 5 years. So I now cede the floor to you, Andrew, and thank you very much for coming to us tonight.
Thank you very much. It's an absolute pleasure to be here. I appreciate the invitation from Jennifer, who I've known for a while, and Matt and Kelly. Thank you very much for coming. We've met online, but it's great to meet you in person. I just arrived here in Melbourne, I guess, sorry to pronounce it that way, maybe yesterday, and I'm knocked out. This is a spectacular city. I understand maybe it's design week, but it must have been design week for the last 40 years because the architecture is spectacular. And I had the pleasure this morning of going to the Melbourne Now exhibition at the NGV, which really blew me away. I was so impressed with what's going on over there. So you locals do get there. as well as the Parliament tour, which I would recommend as well. So with that, let me thank as well our sponsors, CLARS and BFSLA, as well as those who sent me over here, including the Institute for Humane Studies and my home institution, University of Colorado Law School. So it's been 5 years. Well, so here's my home institution, the University of Colorado Boulder. This in the front, you can see the football stadium, well, we call it football, and it seats about 50,000 people, and it's used 6 days a year. But those are very exciting days, I can tell you. Among other things, we have a live bison, a live buffalo that runs out on the field and does a lap. It's a female. Her name is Ralphie, and it's always win or lose. It's always a great part of the game. As Jennifer was kind enough to mention, I am the author of one book, and it will be published later. I would call it this summer, but I guess this winter in July by Oxford University Press. I call it investment crowdfunding because this topic that we're covering is different terms are used in different jurisdictions. It's called crowdsourced funding here. New Zealand calls it equity crowdfunding. There's other terms, but here it's a very auspicious time to be here in Australia because it's really been 5 years, almost exactly, kind of since this experiment in securities regulation got started. So let me tell you what I'm going to talk about here tonight. Here's the roadmap for the discussion before we'll receive the comments from our able and knowledgeable commentators here. Let me begin with a definition of what is investment crowdfunding. I'll go on to describe the policies behind it, the goals, what are we trying to achieve. I'll give you a little bit of insight, and perhaps our commentators will give us some more on the results. What's going on? Has it been achieving these goals? The next topic, and this will be kind of probably the main part of my talk. It's maybe sort of an esoteric term, but I mean, I use the term private ordering to mean non-legal ways that private parties organize themselves, make decisions to advance, that turn out to advance the goals of investment crowdfunding. And then finally, I am a lawyer, and here we are at Law Chambers. So last but not least, I will describe to you a little bit about the legal regulation, the laws in place here in Australia, and compare them a bit with other jurisdictions. Definition. I define, in the book, I define investment crowdfunding as the public offering of unregistered securities through an independent online platform. And what I'm trying to get across here is a few different concepts. First of all, the basic principle of securities law, going back to the Securities Act of 1933, and there are securities acts in Australia and elsewhere, the basic rule is prior to offering securities, investment opportunities to the public, they must be registered with ASIC or the SEC or whatever the relevant regulator would be. And registration is a process of essentially mandatory disclosure where the company that's seeking to offer the securities will submit a thick stack of documents with the financial condition, expectations, everything you might want to know about a company. It's a very expensive process and worthwhile, but investment crowdfunding is a way to make a public offering of securities without registering, without having to register them. And then this final piece, that the offering must go through an independent online platform. In terms of the online part, investment crowdfunding is exclusively conducted online I could perhaps stand up here and tell you a little bit about a given offering, but if you wanted to invest, you would go onto a website, a platform like Birchal, or there are others. And this is, you might say, well, okay, but this is a big distinction between things like cryptocurrencies, non-fungible tokens, NFTs, initial coin offerings, Bitcoin, Ether, all these sorts of things. Those sorts of, whatever they are offered directly from the promoter to buyers or investors. And there's maybe a special danger in that sort of relationship, because the promoter has every interest to get the money, and maybe once she does, who knows exactly what she's going to do with it and what she'll say to try to get it. But by having to run the offer through a third party, through an online platform, this creates a situation where there's somebody looking over the offerings before they get to the public, and so it's sort of a fundamentally different system than other online fundraising techniques. And one more point is investment crowdfunding or crowdsourced funding grew out of an older, maybe about 15-year-old concept of reward crowdfunding, like on Kickstarter, or there are other websites as well, where somebody wants to develop an app or a new watch or a chili bin, I don't know what you call it, air cooler, and they raise money from people, but they're essentially pre-selling the product, and you get a reward, or you might get your name in the credits of the movie. But investment crowdfunding takes this a step forward to allow people to invest. So why? There were laws passed in the US in 2012, in New Zealand 2013, Australia 2017, and revised in 2018. Why did parliaments around the world and governments around the world enact this new way to sell securities to the public? Well, I view it as I see three primary goals of crowdsourced funding. First, it's a new source of capital for early stage ventures. Startup companies are widely viewed as socially beneficial. They grow the economy, create new jobs, develop new products. But in many places, Australia included, it's been widely felt for quite some time that there's just insufficient venture capital and angel investing for the number of quality companies and good ideas that are seeking to be funded. So first and foremost, just a new way for startups and small businesses to raise business capital. The second and third goals of this project, this new way of raising money, really relate to inclusivity. And inclusivity in two ways, or on both sides. First, inclusive entrepreneurship. In the US, at least, I know a little bit less about Australia, but I imagine it's probably not so different. There are certain geographic areas that are the center of venture capital. In the US, it's Silicon Valley, and to a lesser extent, New York, Boston, LA, a few other places. But what if you're a geographically remote entrepreneur starting up a company in, let's say, Tasmania? In the olden days, 6 years ago, you'd have to move yourself to Sydney or Melbourne and try to find some venture capital that way. But part of the goal here is to allow any entrepreneur from anywhere to give it a go, and not just geographically inclusive, also the statistics on women-owned, women-founded ventures and minority-founded businesses are not great. And traditionally, various groups, for one reason or another, have sort of been out of the loop and have had trouble getting their foot in the door, getting that chance to raise money from venture capitalists or angel investors. And so investment crowdfunding is designed to be a more inclusive way for entrepreneurs of all types to have their chance to give it a go. And then finally, from the other side, what about the investors? I keep using these terms, venture capitalists, angel investors. These aren't legal terms. Under the law, there are, like I've said, the general rule is if you want to offer securities, they must be registered. But it's such an expensive and time-consuming process that apart from the largest, most successful corporations, the name of the game is to figure out a way to find an exemption to offer the securities in a way that you don't have to go through the formal IPO process. And so the two main exemptions for a long time have been for wholesale investors. We call them accredited investors. These are rich people. Nothing wrong with rich people. And the other type is a private placement. As long as you're not doing a public offering, you don't have to register them. But so the effect of these two rules is that for decades now, startup companies seeking to raise money have studiously made them the offerings extremely exclusive. If you're a friend of Mark Zuckerberg, you can invest in Facebook. If you have $1 million, you can invest in Facebook when it was a startup or whatever it was. But if you're not wealthy or connected, you were left out. Crowdsourced funding here in Australia and elsewhere is designed in part to include all investors, retail investors, that's just non-wholesale investors, and everyone who wants to give it a go. So, well, how are things going? Let me give you a sneak peek of the book. I've got this is a table from the book, and we'll see a couple of these. What I'm showing here is investment crowdfunding in the United States, and I'll come to an international comparison in just a moment. But so like I said, the U.S. enacted a statute, a new law called the Jobs Act. Jumpstart our business startups, jobs, good name, in 2012. But it didn't really jumpstart anything because part of the statute called upon the Securities and Exchange Commission to promulgate regulations. And Congress in the US, we have a Congress, ordered the SEC, get it done in 6 months. Well, 4 years later, the SEC issued the regulations and the market was underway in 2016. As you can see, it started off pretty small, but it's grown quite significantly over the years. The number of offerings was under 200 in the first year, but nearly 1,500 offerings in the most recent year that I had statistics for. The percent successful, one of the rules of investment crowdfunding in most jurisdictions, it's a law, and in others it's just the practice, is that the company seeking to raise funds must announce a target that it's seeking, and this is how it works on Kickstarter. We want to raise $80,000 to do whatever it is. If the crowd only invests or only pledges 50,000, well, you didn't meet the target. The crowd wasn't impressed. Nobody goes forward. The 50,000 just goes back, and everything's canceled. So, but if you hit your target, then you can collect the money. This is called the all or nothing model. And as you can see, the percent successful initially was only about 50-50, and now it's 72, and really even higher than that. I kind of want to say this is a good thing, but it's a little bit of a phony thing. And this is one of the parts that I'm going to talk about when I get to the law, is in the US, there's no, and I think this is generally true elsewhere, there's no rule on what you have to state as your target. So you might state $9.25, and lo and behold, you were hit it. You did it. You were successful. Your mom invested, and you were successful. So, and in fact, and this is one of the criticisms I have of the U.S. System is Yeah, and look, I'm a proud American. I love the country, and we have a special way about us, which is to push everything to the absolute limit. And so the platforms that run these crowdfunding offerings in the US, they have kind of developed a practice of, one of them has all of its companies declare $10,000 to be the target. Another one, 25,000. But generally, they're these kind of absurdly low figures for companies that really need 250,000 or whatever it is. But you can call it a loophole, you can call it whatever you want. As a practical matter, every company that goes on a major platform in the US is successful. This is, I'll come to a point in a few minutes that I call the wisdom of the crowd, which is the goal here of having the target that you have to hit it was so that the crowd would have some wisdom. And if you were one of the people that pledged towards a very unpopular company, the crowd would pull you back and save you from it. But this is not happening in the US. In Australia, from what I've seen, and I welcome your comments on this, and in other jurisdictions as well, companies and platforms choose much more realistic and appropriate targets of often hundreds of thousands, even $1 million sometimes in the UK. And some make it and some don't, but it really is a market test. The number of investors has grown from 20,000, 70,000 to 500,000 people in the most recent year. The average amount invested has stayed kind of roughly the same, more or less in the range of about $1,000. I'll tell you that this hides a large standard deviation, meaning that a lot of people invest $100, $200, and then a few invest $10,000 and $20,000. The total amount raised, we were getting close to $500 million in the US in the most recent year, up from 20 million in the first year. The average amount has grown from 100,000 to 400,000. And this is a key figure here. Raises over $1 million, really hugely successful offerings. This has grown a lot over the years. One important point is that in 2020, the SEC raised I'm sort of skipping ahead, but one of the rules, one of the hard rules, and this is in every jurisdiction, is there's a limit on how much money you can raise in this fashion. In Australia, it's $5 million per year for each company. In New Zealand, it's 2 million Kiwi. I've been writing letters encouraging them to raise that, but in the US, the original law was about $1 million, $1 million limit. But then in 2020, the SEC raised that to 5 million. So then all of a sudden there were a whole lot of companies that it wasn't sensible for them to raise $800,000, but 3 million, yes. And so we've had a lot of raises over $1 million. And I don't have a slide for this, but on the point of the inclusive entrepreneurship, so a new source of startup capital, yes, growing, small but growing. Inclusive entrepreneurship, companies that use this method in the US hail from all states and all over the place, and overwhelmingly are not from Silicon Valley. Again, I'd be curious to hear how the Tasmanians are doing. And then also on the just looking at the raises over $1 million, of that group, at least maybe in the most recent year or two, about half are women-founded businesses, and nearly half have a minority founder. And these numbers are 10 times the numbers in traditional venture capital. So that really is quite encouraging, I would say. Here we've got a chart to give you some idea of how different countries are developing in the same way. And what we're looking at here is these are all in US dollars, a little bit rough, but good enough for our purposes, all in US dollars and per capita. Because I mean, the US is 10 times the size of Australia, 100 times the size of New Zealand. And so it's not really a fair comparison to just do dollars per dollars. And so as you can see, the US has grown steadily, as we just saw. Australia started late, a little bit, but really maybe had the wisdom of experience of what's happened in other jurisdictions and really jumped out. And we're looking at a big part of the story in the front row over here, to the point that in the most recent year, by my count, this is really one of the top in the whole world, maybe just behind the UK. New Zealand, I'll talk more about their legal system, which I'm quite a fan of. And they started off strong and have really kind of stayed there. I think that this is a lot a function of of that very low $2 million limit in New Zealand. And so what ends up happening in New Zealand and other jurisdictions as well, and I'll talk more about this piece again also in a moment, is that a platform will put together a side-by-side offering. They'll do a crowdsourced funding offering to the max if it's a popular company, and then also have wholesale investors invest at the same time. And so the amount of money that's raised for the Kiwi startups is much higher than this, double or triple, but formal crowdsourced funding is just this. And then the UK has really just been the world leader. They started earlier in about 2010, and really have, again, a legal system that I'm quite a fan of. And as you can see, this has become a really major part of their investment landscape, to the point that the two leading platforms there, called Seedrs and Crowdcube, they sought to merge, but the competition authorities in the UK blocked the deal, saying, this is too important of an industry and you two are too dominant. So, well, so sorry for them, but it's kind of a compliment to what they've accomplished. So from the earliest days, there was concern that dodgy or fraudulent or low quality companies would be raising money in this way, and your poor old public investors, the retail investors, aren't receiving all the full registration materials. And so what's going to happen? I've been thinking about this, and so I'll come to the law. I swear I'm going to come to the law. The law has something to say about this, but I think, and that's why I put it first, more important than the law is what the private parties have done. And so first and foremost is, I call it gatekeeping. Like I said, if you want to offer securities in this way, you can't just go ahead and do it. You need to get listed by one of the platforms, and the platforms are strict. They look at a lot of companies that come before them. Numbers that I've heard from other jurisdictions, and again, I'm keen to hear what we have tonight, is that upwards of 95% of companies that seek to participate are told, sorry, this isn't the sort of thing for you, you're not ready, or we just not willing to put it up. And so the gatekeepers, wanting the investors to come back again and again and again, really it's in their strong financial interest to only allow legitimate and promising companies to list. Number two, voluntary disclosure. Like I said at the very beginning, the basic principle of securities regulation is that we need to mandate that companies provide disclosure so that people will know what they're getting into. But you don't really, or at least to some extent, when you're dealing with a primary offering where I'm trying to raise money from my company from you, if I stood up here and I said, oh, I'd like you to invest in, Schwartz Incorporated, you say, well, what does it do? Not telling. You have any money in the bank? Not telling. Who's your chief executive? I will not tell you. I don't think that you're going to invest, or you might for a nickel. And so there's a powerful private incentive for promoters to provide voluntary disclosure in a primary offering, which is what we're talking about. The promoters that list their companies on websites like Birchal, they put their online reputation on the line when they do that. There's a link to their LinkedIn profile or similar, and if you were to misbehave or run away with the money or give misleading information, this would tarnish you forever. And so you probably won't. It'll, you might not be able to get a job in the future, or even a girlfriend. And so online reputation is a powerful private limit on opportunistic behavior. The digital trail, by digital trail, I mean, from the beginning, people said, not me, but people I know said, well, there's going to be con artists prowling and trying to raise money through this. Well, it's just the worst way to do it, because you have to link your bank account and your name, and everything that you said is listed there on the website forever. It's like robbing a bank in the snow. There he is. It's just too easy. So the digital trail really keeps things keeps it clean. I guess snow is this thing we have in America where if you run through it, it makes tracks. I guess I could say mud. I'll say mud. Wisdom of the crowd, like I mentioned, the target, having to have a target and having to hit that puts an idea to the test of what do the people think? What does the crowd think? And sure, I mean, angel investors, venture capitalists, these are smart folks that know a lot, but it's fundamental that nobody knows everything. And even 5 very smart people in a room can't figure everything out. There's information, there's knowledge from everyone's different experience and background. And it's aggregated in this way in the wisdom of the crowd through the all or nothing process. Like I said, this component has been snuffed out in the US to my chagrin. Finally, syndication. I borrowed this from the world of angel investing. And the idea is angel investors are often like a club, like all of us sitting here. And we say, oh, we're all going to put, $10,000 into a company. Let's have Jennifer. She's an expert on biomedical devices. She might be. She goes and researches the biomedical startups, and she says to the group, this is a good one, let's go for that. So we all follow her, and she's our lead investor. Similarly, in crowdsourced funding, often, very frequently, a wholesale investor will be kind of a cornerstone investor, a lead investor, and will give a little note up on the platform that says, I'm Jennifer Hill. I'm an expert on biomedical devices. This looks very promising to me. I've known the founder since she went to uni, and I'm investing $80,000. This gives the whole crowd some comfort and some, the benefit of her experience. And if you're going to invest $200 in a startup, it's nonsensical to spend 30 hours researching the company, but you could say, well, this is somebody who knows what she's doing and she's put a lot of money in it. And so this is commonly done in the US. And at least one of the websites in the US, one of the major platforms, requires that every company appoint or find someone who's willing to be the lead investor and to put their own name out there and say why they're investing. So finally, the law. After all that, you might say, what do we even need law for? And that's part of the point of the book, is that regulation is valuable, but every bit of it costs money. And when you're raising modest amounts of money, which by definition, that's what we're doing here, the costs need to be kept to an absolute minimum for the system to function. So I kind of split the world into 2 types. New Zealand and the UK over on the left side, I call these the liberal jurisdictions, liberal meaning free and deregulated. The rest, starting with the US and Australia as well, I refer to these as following a standard model. And by standard, I use the term standard both because the US kind of just created the standard, and Australia and Canada and the EU have kind of followed it, but also because the standard model jurisdictions use the standard tools of securities regulation, namely mandatory disclosure filed with the SEC or ASIC. As you can see, all jurisdictions require that a platform that wants to conduct this sort of business first get a license from ASIC or the SEC or similar. And I think that's a very sensible rule. It's good for the platform to be overseen by the regulator, and then the platform to run its own shop kind of as a gatekeeper. As you can see, the big split here is on mandatory disclosure. The US and Australia have a required set of information that must be provided. New Zealand and the UK don't, and it's up to the platforms and the companies to decide what are we going to disclose in what format, which is less expensive at the very least. Like I said, there's an issuer limit, the amount that you can raise annually. It varies. I think Australia, let me say Australia on the whole has a very good system. I would kind of slim down or eliminate the mandatory disclosure component, but it's not terribly onerous. And the other components of the Australian law are more or less what I would recommend for a jurisdiction. This $5 million limit is quite appropriate. It's not so high that huge amounts of money are being raised in unregulated or unregistered offerings, but startups really often need 1, 2, 3 million. Those are sort of the numbers that they need. So the 5 million is very sensible. Investors, to protect investors from putting their life savings in some company that is, startups are wonderful, but also highly risky. And many of them are going to fail. So most of the jurisdictions, but not New Zealand, have a limit on how much each investor may invest. The US has a complex formula that I'm not such a fan of. Australia has I think, a very good rule here, 10,000 per offer. I mean, you could, if you're a retail investor, invest 10,000, 10,000, 10,000, and then before you know it, you're really in. But at the very least, you're diversified. And look, you could go to a casino, you could buy a ute, you can do a lot of things with your money. We call them pickup trucks, but I'm trying. You can do a lot of things with your money. So I feel that as a competent adult, people should be allowed to invest as they wish. But at the same time, you could get in a lot of trouble if you're a retail investor that puts your life savings in one of these things. So Australia, I think, is a very sensible limit. The US and certain other jurisdictions allow any type of security, options, bonds, convertible notes to be offered in this way. Australia and New Zealand only allow equity, common shares. I think, as you could probably tell by now, I'm sort of a freedom-loving person, and I would recommend letting companies raise what they want, as long as it's fairly described, including because, as a practical matter, early stage ventures are often seeking other types of securities, and if they can only offer equity in this way, well, they're not going to participate. And then just finally, a minor point, there's a cooling off period that if you get overly excited, you can cancel within 5 days here. Other jurisdictions have different rules. The US has a silly rule. But look, we were the first ones. You had the benefit of our stumbles. In the US, the cooling off period is measured from the time the offer is going to close. So you could have $3 million pledged or nothing. You just don't know until the final 48 hours, which I don't think that's a good idea. I think this 5 days, 2 days is a very sensible rule like you have here in Australia. One other item that's actually not up on here is, again, for the wisdom of the crowd to function, it's sort of, we want to see, did you get enough pledges to hit your target? Well, how long do you have? In the US, you can name your time. So companies say we're seeking $10,000 and we have a year to get there. Okay, but it's not good for the company. They should raise the money or not and get on with things rather than having this hanging over their head. And so certain jurisdictions, and Australia is one of them, have put about a 3-month limit. Canada as well, a 90-day limit on how long these offerings can be open. The UK and New Zealand, I don't think have a limit. They're liberal jurisdictions, but their platforms routinely make it 30 days, 60 days. So those are really my comments, and I, in a bit of American self-promotion, I posted an advert on the board here to purchase the book, and there's an online what's this called, a promotion code that you can use to get 30% off of the rather high price, but you might recommend it to your local library or your university or your startup friends. So with that, let me go to our commentators. Thank you very much for your time.
Thank you, Andrew. That was fascinating, and it's quite interesting. Quite interesting and very nice to hear someone that has clearly done so much work on this space, because we live it every day. 5 years in, Birchal was among the first 7 platforms to be licensed. As you pointed out, the legislation was really implemented in 2 phases. So we had a public unlisted company regime for a period of time, and then 6 months later, it was extended to proprietary limited companies. But it's been a real success commercially in Australia. Birchal as a platform has hosted over 200 successful offers and 160 million invested through the platform. And as you've identified, many businesses from around the country and founders from diverse backgrounds have been able to build communities and raise capital at the same time. You'd be pleased to know that there was a high-profile campaign in Tasmania. The founder was from Melbourne, but it was for a business that was developing islands, actually. And it's a great example of the kinds of weird and wonderful things that people can bring to market and find audiences for, where, in years gone by, they might not have got the funding because certainly in Australia, we have a very small professional investor, venture capital community by international standards. And, this is an emerging industry where, founders, and we see every day, coming to us with ideas and the belief that actually if I communicate my message and execute well and build a community, that I've got a chance here, and it's a really exciting thing to be a part of.
I think we've had 2 in Tasmania, haven't we? The Courier.
That's right.
So
yes.
There's 2. It's a bustling industry. And I think we've had most states and territories other than Northern Territory. We still, if any founders out there, give us a go. And I really like the term you used, Andrew, of inclusive, an inclusive investment, either from investors or businesses. I think you hear a lot of the terms of democratizing capital raising, but I think the use of inclusive is actually really good. And it shows crowdfunding over the last 5 years, it shows it's kind of industry agnostic. So it doesn't matter, there's always some really hot industries. I think medicinal cannabis is a big one at the moment. We've seen breweries, obviously, it was really useful. Crowdfunding can be a really useful tool because everyone wants to own a bit of the bar that they go to around the corner. But a courier business or, islands or a nail polish business or whatever it might be, I think crowdfunding can really be a tool where traditional forms of fundraising don't really work for them. Going to the bank, not helpful. Other debt venture funding is not helpful either, or VC funding as well that we know is not there for everyone. So it's really filled that spot in this country that prior to 5 years ago just didn't exist for people. So yeah, the use of inclusive, I like that. I might take that. I also like investment crowdfunding. I think that's a far more useful term perhaps than crowdsourced funding or CSF, which it's known here.
Although we funder in the States are starting to call them community rounds, which is a really nice element to it as well. Just covering off on this kind of like regional and non-metropolitan feature of crowdfunding. We have a statutory maximum of $5 million, and that's been reached twice now. Once, the first time, ZeroCo, which is impactful, mission-driven business on a mission to untrash the planet by eliminating single-use plastic around the home. So they have plastic bottles that, and they sell cleaning products in refillable pouches. So you fill the plastic bottle and then send the pouch back, and they'll clean it and send it home. They had about 40,000 customers at the time that they came to us and reached their $5 million target in 7 hours. About 3,500 people invested, and they were dynamically reducing their maximum parcel size throughout the day, which is not something that we encourage. But because it was important to them that they had as many people invest in their campaign as possible, they're based in Byron Bay. The $5 million maximum has been hit for a second time a couple of weeks ago for a medicinal cannabis business based in Collie, Western Australia. So the $5 million maximum has been hit twice by two regional businesses. And Collie, I haven't been there myself. I hear it's a beautiful spot, but it's well south of Perth, somewhere in the Margaret River region, and very, very small town. So
there was a bunch of points you spoke to, Andrew, and now I can't remember them. That for the comparative, I said, yes, I want to talk about that, and I want to talk about that. I think one of the interesting points you did talk about in the US, which I didn't realise, was setting that minimum target to $10, and you get, I think it's interesting, and we get the question a lot, because in Australia you need to set your minimum target and also your maximum target. So companies don't want to set their minimum too high, so it won't be successful. But they also don't want to set their maximum too low because they feel like they might leave some money on the table. So it's a really fine line, and we've got a bit of a process to help companies through that, the way that we've structured the platform. But I think one of the couple of the key things that probably go to that, how the market practice has changed in Australia, is one is probably the actual security type. So in Australia, because you're only able to issue ordinary shares, it needs to be worthwhile for the company to even do it in the first place. So if you do an offer and your minimum is $10, you've then got a shareholder sitting on your cap table for $10, and then what are you going to do with that $10? And that kind of then leads to the second point, which is the mandatory disclosure, or the offer document that you have to prepare in Australia. If you have an offer document out there that says, I'm going to achieve all these wonderful things, but then you only raise $10, all of a sudden you've probably got a misleading offer document that says, I'm going to, take on America with this $10, and that's it. So there's kind of a few things that kind of pull together, which make which has informed that market practice. But and it's also interesting that really, it does test the crowd. So I think early on in Birchal, I thought I could pick the winners. No, you just got to let the crowd decide. And I think having that minimum set at the right level, actually, and just because a company might not be successful today doesn't mean they can't be successful in 6 months or 12 months' time. A lot depends on what's happening in the zeitgeist at that time, how the company's going at that time. Has there been another news story that's caught the attention for that 3 weeks? There's a lot of things that go into making a capital raising really sing at the certain time.
Yeah, completely agree. And the wisdom of the crowds was certainly a concept that thought back to, I'm going to butcher his last name, James Sorowski's book on the wisdom of the crowds. We built our expression of interest process really to leverage that to give us insight on how the crowd was responding to an opportunity. And this was a concept that wasn't really, I think, contemplated by the regulators when they were putting the regime together. Very helpfully, though, we're allowed to advertise these offers. And, I mentioned this as one of the key game changers of the legislation that we have to work with, is that provided you include a short risk warning, we can advertise on any medium. So it's pretty hard because you put all that work into the offer document and then open the offer and you need to see how the crowd responds. So we thought to ourselves, well, how can we get some insight on how the crowd will respond before we've opened the offer? Because once it's out there, you can't change anything about it, certainly not for convenience. So this expression of interest process has become critical to how we execute these offers. And we use the data to help set minimum and maximum targets. And like all capital raising, momentum and scarcity are key. And that's really been central to a process. And I think a big part of how we've been able to repeat success and shorten the timeframes for these offers as well. So 3 months is way too long to execute an offer. We like to do it in a few weeks or sometimes a few hours. So.
Yeah, that's right. And that also probably goes to the mandatory disclosure point, is that if you have an offer open for 3 months, 12 months, a lot probably materially changes, particularly in startup life, in your business over that period of time. So do you have an obligation to be updating the market like a listed business does? And it's something that we think about all the time as well. If a company keeps an offer open too long and something material changes, you do need to update the audience because your offer document is misleading. So it's probably worth talking about the offer document. And it's an interesting point you make, Andrew, but in other jurisdictions where it's not required, the mandatory disclosure is not required. We actually kind of like it in Australia. Shock, I'm a lawyer. You probably expect me to say that. But I think what's good about the law in Australia is actually provides a pretty good baseline of what you would normally expect to see if you were going to invest in a business anyway. So if we scrapped the offer document, which is what's required here, and think about, okay, what would I disclose to the market anyway? It's probably the financial statement, is my business model, it's my business strategy, it's a few risks around my business. All of a sudden, that's your offer document anyway. So I think the template provided in the legislation gives a really good baseline for companies, particularly startups who've never done this before. They've probably prepared a, 10-page pitch deck, which doesn't really give any useful information anyway. So it's a good discipline, and I think that's a really good baseline, and then companies can obviously add into that if they want to. No company enjoys doing it at the time, that's for sure. But most companies have said to me after the fact that it was a really good, robust process for them, and something that they have returned to over time as they get more and more sophisticated. So we've kind of really embraced it. Try to simplify it, try to demystify it for businesses going through, because it can be a pretty daunting thing. But we think it's actually a really good part of the regime down here.
Yeah, I'd say it certainly makes our job a lot easier as an intermediary, because a lot of these things they're just not up for debate. And it's not as though people haven't been raising capital, early stage capital, before crowdfunding. So there's been a lot of practice that has evolved, pitching things to wholesale investors under unregulated IMs and things like that, that we can't support and condone in our world. So you won't see on Birchal, pre-IPO offer, but these things proliferate in wholesale investment circles, and I'm always curious when there's 5 or 6 pre-IPO offers done. So how many pre's? So there's lots of these things, and as Kelly said, it's a really good discipline for companies to have, ASIC's guidance on what retail disclosure needs to be and having a reasonable basis for things. And yeah, I agree. Like companies then embrace it as well, and most of them, I think enjoy it at the end once it's done. So.
And I think it gives a level of credibility to your offer. You've really thought about your business. And if you want to attract wholesale or sophisticated or accredited investment in your offer, then you do need to prepare something substantial for them. I think it's a bit of a misconception that crowdfunding is just for mum and dads. Mum and dads are pretty intelligent as well, and they know what they're looking for. And if you do want to attract the VC funding that can come through crowdfunding as well, then you do want to prepare a pretty robust offer document. And or I like the term as well, Andrew, that you were talking about, syndicates, where I like to say that the Birchal community is probably the largest angel syndicate in the country now. Investors are just people, and crowdfunding is a mechanism to kind of bring them all together.
Oh, yes, absolutely. Investors are just people. This is a big one because often, I don't know what it is about companies when they start to think about sophisticated and wholesale investors, people that are comfortable dealing with complexity, and then they prepare like a really complicated offer document or really complex information because that's what the investor will expect of me. I suppose in our experience, there is absolutely no downside to simplifying your message. I think that's what like a lot of founders realize in our process is that by going out to the retail audience and really simplifying, distilling it, so then you can appeal to the everyman. If people are interested or they want the complexity or more detail, like they will ask for it. But solving for the masses is probably one of the biggest unrealized benefits of going through a crowdfunding process. So, yeah. Should we talk about what we want?
Why not?
The $5 million limit, I think it is appropriate. It's a good number. But one of the things, there are a range of retail disclosure documents in Australia, and most people would be familiar with the prospectus, and then the crowdsourced funding offer document is at the lowest level. But an offer information statement is something that not many people have heard about, but it's a regulated disclosure document where you can raise up to $10 million only for public companies, and it's a reduced level of disclosure to a prospectus. I think in our discussions with ASIC that it's not used a lot by companies, and mainly for unlisted public companies. But it's probably, there are a few companies, particularly now we've hit that $5 million maximum twice. I think it's probably time for us to, start to consider whether or not that maximum could be increased. But there probably is an additional level of disclosure that would be required for that. In terms of the investor limits, I think 10,000. I was surprised that we got 10,000. I think we were talking about 2,500 when the legislation was being considered, and $10,000 I think is pretty generous. Birchal hosted, I think, 60 offers last year, so you can do a lot of damage if you invested in every single one of those offers. So I think it's one of these safeguards there that works for us. But most people do take a diversified approach and invest across many. The 5 days cooling off, I think it is incredibly important, particularly given the way that these opportunities are marketed. A lot of people say that crowdfunding is hype marketing, and we're really trying to get people to make an emotional decision. And yes, that's what it is. It's a marketing campaign appealing to a community and trying to get people to take an emotional and financial decision at the same time, without an appropriate cooling off feature. That would be, I think, a really difficult industry to sustain and encourage. So it's a really entirely appropriate investor protection. Do you want to talk about security types?
Oh, love to. I agree. I think we would love other security types. We've tested now ordinary shares, and it's worked well. And it's surprising actually that how well it has worked, given, as you say, startups are often looking at other types of securities, safe notes, convertible notes, other classes of shares. Preference shares obviously is a hot topic all the time. So I think the ability when you're doing a crowdsourced funding round, offering ordinary shares, you need to put a valuation on the company, and that can be a finger in the air. You know, the companies have been operating a couple of years, who knows? So it's not always appropriate for startups to be doing that. And something like a safe note, for example, kind of pushes that conversation down the road a little bit. So I think now we're up to over 200 companies. What did you say? 160 million raised on the Birchal platform since we've started. I think we've tested ordinary shares. It's worked really well. So I think we would love to see other classes of shares to give more choice to more other types of companies who could use the regime as well, because it's got all the mechanisms. It's got the cooling off rights. It's got a disclosure document. Everything is there for the regime to work.
I feel like we've taken a lot of time. I've got one more comment. I know you might have a last one as well, but having a look at that table up there and seeing the per capita investment, that I didn't realise that the UK's was as high as it was. It's unbelievable. I knew that they were active crowdfunding investors. I didn't realise the distance between us. In the UK, they have an enterprise investment scheme and seed enterprise investment scheme. I wonder whether the tax incentives for investors that are backing these can explain how significant that difference is. We're extremely proud of what we've achieved in Australia. We haven't only built a platform, but we've been contributing to growing a new industry, and we've done it with very little government support. I think a couple of de minimis R&D tax claims, but other than that, it really hasn't been very much. And there are lucrative tax incentives for wholesale and sophisticated investors for investing in early stage businesses. And now this is a risky asset class, and retail investors diversifying into it, but not enjoying the same benefits that rich people are. So there's definitely a lot that can be done on that front, and we've said that to government. So I
think that's it. I don't think I have anything else.
We've got some questions that we can ask. Andrew, how about you go? So we've got time for some questions, and I understand that Emily is not going to be taking any online. So we're going to be taking questions from in the room. And I mean, I had a question. I find this all completely fascinating, and the idea that, this has come in to fill a lacuna, that small businesses can't get loans from banks. It took me back to post-global financial crisis, when I heard that in Italy, when nobody could get loans from the banks, the mafia stepped in to make loans. And I thought, you guys are so wholesome. This is such a very positive way to fill that gap. But I don't know a great deal about this area. My colleague, Steve Karabits, is an expert in this area. And unfortunately, Steve is in Europe at the moment. But certainly one of the things I understood from the beginnings of equity crowdfunding in Australia was that it was very sort of pro-social movement. As you talked about the democratisation, I think you have up on your, platform that you're, for people who want to save the planet. And yet when you were all talking about it, it seemed to be a much broader concept now, that it's just about entrepreneurship and people that have got a great idea about, nail polish, for example. And I just wonder, how does that go comparatively across different jurisdictions? Do you find some jurisdictions are much more pro-social than others? And how has that kind of featured into the Australian trajectory?
Well, I'll just say generally, it was a very good point, Jennifer. And from the beginning, and I think still today, the investors that are participating in any given offering, financial return is one of their motivations, but it's almost always combined with something else, whether to specifically fund, Black entrepreneurs in the U.S. or a certain type of environmental concern, like zero is another good example there. It's quite common that to get the crowd interested, there's often another component. But tell me about Australia.
So we didn't set out to build a platform that was purposeful or impactful, but in a sense, that's what we've become. That's how people see us. And many of the, in fact, most of the businesses are pursuing a mission or an impact that, and I recognize I'm fumbling over the words, because this is a tricky area at the moment. We don't know how to talk about the things that we're aligning ourselves around and going after. But businesses are building communities of investors, and it's not just about an investment return. And I think investors are able to reconcile the high risk, the chance of failure, the chance that I'll lose my capital, with a knowledge that if this company succeeds in their mission, the world will be improved in some way. And we've had lots of great businesses that are at the start of that journey that are, not only raising capital to build a business, but also to raise awareness for an issue. And it's, something that we're actually working pretty hard on, trying to add some structure and some rigor around this, so more and more founders can be comfortable with raising capital on a platform, not on our platform, but on a mission-driven platform. Yeah.
You got anything, Kelly? Or?
Yeah, look, I think it's been interesting to really see that investors coming through the platform are always either investing with their head or their heart, I like to say, or sometimes it's a combination of both. And I think maybe it's just interesting to see that startups are the businesses that are starting to care about or have been caring about these issues that we're not seeing in corporate Australia. So investing via the ASX, let's see who else is trying to solve these issues. And I think it's great to see that investors are thinking about this, and I think it might flow from the bottom up.
Well, that was my follow-on question. And please, people in the room, if you do have a question, just raise your hand and we've got mics over there. But my follow-up question, it's funny to me hearing you talk about this, because it almost takes me back to the 17th and 18th century in England, where, of course, you had the big, government royal chartered corporations, and then you had these gutsy little startups, which were the, the unincorporated joint venture companies. And of course, the big ones didn't like them because they were shifting investment across, and so they were trying to get rid of them, which is what the Bubble Act was all about. Let's stop these gutsy get up and go companies from taking away some of our business. And so, one of the things I think is so important in the last few years is what you're saying, Kelly, the fact that the ESG and corporate purpose is filtering into the bigger end of investment. And I just wonder, does that make it harder to differentiate yourself, or is that a good thing if you've got benefit corporations in the US? We've considered having benefit corporations in Australia. I mean, how is that changing? Because initially you must have been quite different from ASX listed companies, but is that difference becoming more blurred because of these developments, I guess, is my question.
Yeah, I think it's interesting. I think ESG and sustainability has really become quite a buzzword. So I think, and what sort of Matt was alluding to is that to stand apart, I think you need to have some credibility around the statements you're making in terms of what you are doing for the environment or for social purposes or for whatever it might be. And I think it's going to be a really interesting time over the next couple of years. And obviously ASIC and the ACCC are doing a lot of work around this at the moment as well. I don't think companies now can just come out and say, we're doing good for the world. I think you have to be quite clear about what that means. And also if I'm doing good over here, but doing bad over here, kind of being quite transparent about that. So yeah, I'm not sure that answers your question, but I think it's going to be an interesting time.
Yeah, it's not a time to engage in organisational hypocrisy, that's for sure. Can you just mention who you are and then ask a question?
Adam Vyse. So I'm a director with these two at Birchal. And maybe it's more of a comment, but keen to hear any reflections on it, and particularly overseas. Is one observation about equity crowdfunding is there's no disintermediation. So the people whose money it is, they put it into the company, and therefore the connection and the purpose of their intent with their capital. And I always wonder, one of my side gigs is to also be an investment committee chair at a super fund, and where I'm asked to do ESG and go, I'm meant to divine what my investor, the membership base, was wanting. And it doesn't feel right, because how can I know their moral predilection and then be a representative of their moral position as well as chasing the investment return? So I guess maybe one for Matt is, is there scope here of actually becoming a more efficient model for actually ESG than big corporations with fund managers, with investment trustees, like 5 layers of moral sort of irrelevance, trying to predict what people want, whereas is equity crowdfunding a better joint stock company?
Oh, I completely agree, Adam. Glad you asked that question. I think, yeah, as a society, we are becoming more thoughtful, more purposeful, and the things that we choose to invest in, as we've seen, there is a real opportunity for businesses at the grassroots level to change things from the ground up. But it's critical that they're clear about what they're going after, so investors can make these choices. And we might not all want the same thing, and that's okay. We're a diverse society, but we've just got to, have a reliable framework so we can find and make choice.
This has been a wonderful presentation. Thank you so much. I'm very familiar with this area and found it equally fascinating. So you really hit both ends of the spectrum.
Colleague Tamara Wilkinson. Tamara, ask away.
So I have, I guess, a question for both of you, but I think I've only got time for one. So Andrew, in your comparison, your international comparison of the amount of capital raised, the UK, as we've talked about, was obviously much, much higher. Do you think that's a reflection of the fact that the UK regime is not targeted towards startups, whereas Australia's, for instance, I'm not sure about the US's, absolutely is targeted towards these really small early stage companies? Or do you think they're just great at crowdsource funding?
A good question, right? The UK, it's directed at startups. In the US, it's the Jumpstart Our Business Startups Act, but it's not. There's no formal requirement. You could be a 40-year-old drive-in movie theater that's trying to make it, and it doesn't. But so how is the UK doing so well? One thing is it's 8 years ahead of Australia, and maybe Australia will be there in 8 years. It keeps growing. Also, it's really they've done a very good job there of coordinating between the big wholesale investors and the crowd. And just the other day, there was a very successful offering, or maybe within the last few weeks, one of those UK platforms, an app called Clue, CLUE. It's an app that women use to keep track of fertility cycles and things like that. They had, I think, $7 million already raised from VCs, but they wanted to raise another $1 million from their crowd, and they did very quickly with 85% women investors, and so many of them are users of the product. So I just think that they've done a good job of integrating into the broader system there, and it's to the point that investment crowdfunding in the UK is larger than angel investing, just a little bit.
Hi, my name is Nathan. I'm a student intern with CLARS, and I just want to also thank you guys for coming to speak with us about such an insightful topic. My question relates to that table at the end of your presentation, Andrew, about the comparative law and how I think it's in New Zealand and the UK, there aren't any mandatory disclosure requirements for crowdsourced funding. And I think we've already heard from Matt and Kelly today about some of the implications that mandatory disclosure requirements might have on companies seeking funding. Do you guys have any, and as crowdfunding becomes more and more prevalent, do you guys have any thoughts on whether or not mandatory disclosure requirements should be imposed? Whether or not there are any dangers associated with that for potential investors, and policy rationales behind that potentially?
A very good question. Very good question. I would say, like Kelly has said before, as long as the required disclosures are very close to what market participants would have done on their own, then there's no waste. Then it's sensible, and there is a benefit to having a form that's consistent from company to company. Makes it easier to compare, and also as my colleagues here said, it kind of they can say to a company, look, it's not me. We have to do this. It's the rules. It's not for negotiation. And so I think the consistency is a benefit, and as long as it's not overly, as long as there's not a lot of additional wasteful disclosures, it's perfectly appropriate. And so I'll give Australia credit for designing a scheme that really fits what the market wants.
Good day, everyone. My name is Jonathan, and interestingly, I did a PhD on the regulation of equity crowdfunding. So this is very familiar territory for me. My question is more towards the intermediaries. Since it's been 5 years or much longer now of equity crowdfunding, is there any sort of like robust data coming out in terms of businesses that have been successfully crowdfunded and how successful they are? What sort of returns are investors getting at this point? Is there any data or that, or what sort of exits are we seeing? And is there a role that the intermediaries can play as well in making sure such information is available? Because I guess it could be one of the things that would help the public, or a potential investor look to, putting their funds in a company. Thank you.
Yeah, it's a great question. And I'll answer for Australia. I might throw to Andrew if there's any data for other jurisdictions. 5 years in, but we're still relatively early, particularly given the return horizon for early stage businesses. VCs expect returns in many years, 5 to 10 years. We have had one exit so far. A business that we helped raise funds for in 2019 called Biome Australia, listed on ASIC towards the end of 2021. It was a good return for investors. We helped them raise, I think, about $400,000. $6 million pre-money. They IPO'd at 40 million in an $8 million oversubscribed IPO at the end of 2021. So a great return for investors. There's a few others that we understand are kind of working towards similar events, which is great. But it's probably not enough. We certainly celebrated that IPO. But that's one data point. We'd like many, many more. As a platform, we absolutely need to be encouraging this if the industry is going to grow. But we need more data to do this. The way that we talk about it internally and externally is that we see this as a new asset class, and what we're doing is just the primary capital piece, but asset classes need secondary trading, that needs stakeholder communication and research, and also infrastructure to be able to function as a reliable way for people to invest and generate returns and recycle that capital. So it's absolutely something that we're working on as a platform to kind of build out products and services and information on those 4 pillars. But yeah, we're still pretty early in the piece.
We've also had quite a few companies actually come back to do second or third raises on our platform. So on paper, there's been returns, obviously not liquid until there is some kind of exit event. And we've also done a couple of pilots for a secondary trading facility that we're working on as well on our platform too. But completely agree with you, and I'm hopeful in the next next 5 years, certainly we'll have more data on that, and we'll be publishing it for sure.
I look forward to reading that data because I don't have good answers on this. There's anecdotal reports of in the U.S. of billions of dollars in follow-on funding from venture capitalists and others, and there have been in New Zealand and elsewhere companies that have been listed. But as it's all anecdotal, and we don't really have any systematic data. But let me just say one thing, which is, Jonathan, your PhD thesis was excellent and was really one of the sources that I've used in my own study on this. So it's great to see you in person. Thank you.
This might be your second book.
Excellent supervision.
I've never had so many crowdfunding nerds in a room. I'm so excited.
I can confirm that. Well, look, we're going to have to wrap up here, but it's been great. And there's a lot of camaraderie in this room. Let me tell you, to the people online. There are people I want to thank, so Andrew, Kelly and Matt, thank you so much for coming along. I do thank my colleague, Steve Carabas, for putting us in touch with Kelly and Matt. Also, thank you to the BFSLA for co-hosting this event with us. Thanks to our events team, Emily and Karen. And thank you to everyone that has been either online or in this very hilarious room. And please do go onto our website and have a look at what the Centre for Commercial Law and Regulatory Studies is doing, because it's quite a lot. So thanks, everyone. And there will be a recording, I think, of this session on our video portal. So you'll find lots of other good ones there as well. So have a good night, everyone, and thank you to all.